Okay, let's create a cheat sheet. Net income is what we start with. When we increase an asset, we subtract. When we decrease an asset, we add. When we increase a liability, we add. And when we decrease a liability, we subtract. Non-cash items such as depreciation and amortization, we add. Does that make sense? Other example. Let's go to E4A. I want you to spend a couple minutes trying to do this on your own using that cheat sheet I just created for you, okay? For the year ended June 30th of 2014, net income for Flake Corporation was $14,800. Depreciation expense was $4,000. During the year, accounts receivable increased by $8,800. Inventories increased by $14,000. Prepaid rent, which is an asset, decreased by $2,800. Accounts payable increased by $28,000. Salaries payable increased by $2,000. And income taxes payable decreased by $1,200. Use the indirect method to prepare a schedule of cash flows. This, which one did I have you guys do? E4. So, Flake Corporation begins with net income of $14,800. The adjustments to reconcile net income to net cash flows from operating activities, first thing we'll do is add back depreciation. And then we look at our changes in our current assets and current liabilities. Increasing an asset means we'll subtract. Decreasing an asset means we'll add. So an increase in accounts receivable will subtract. An increase in inventories will subtract. A decrease in prepaid rent will add. Now remember, liabilities are the opposite. If we increase a liability, we'll add it back. If we decrease a liability, we'll subtract it. So our increase in accounts payable, we add. Our increase in salaries payable will add. And our decrease in income taxes payable will subtract to where our net cash flows from operating activities as of June 30th is $27,600. Okay? Prepaid rent's an asset. So if we increase an asset, we'll subtract. When we decrease an asset, we add it back. So decreasing an asset, like decreasing prepaid rent, will add back. Increasing an asset, we'll subtract. So in this case, decrease in prepaid rent, we add back. The reason we add it back, prepaid rent means we paid the rent in advance. So if we decrease our prepaid rent, that means we show more rent expense, but we didn't use cash for it. Because our prepaid rent's an asset, and then when we use it up, we reduce our asset and we increase our expense. Okay? Let's go back now to our PowerPoint and move on. So, what we've done right now is we figured out how we determine our cash flows from our operating activities. Now we're going to look at how we prepare our cash flows using investing activities, then we'll go through financing activities. So this shows you an example of an income statement, and then based on this income statement, we separate out items based on operating, investing, and financing activities. So what we'll do here, we've done the operating. We're now going to look at the investing piece. On the financial statement with Eureka, it shows they had a $12,000 gain on the sale of investments. What happens when there's a sale of investments? Our cash increases, doesn't it? So when there's a gain on the sale of investments, we actually increase our cash. But showing that there's a gain on it increases our net income. In this case, for investments, the amount gets subtracted from net income to reconcile net income to net cash flows from operating activities. The reason we do this is the $12,000 is included in the investing activities section of the statement of cash flows as part of the cash from the sale of the investment. Because the gain has already been included in the calculation of net income, the $12,000 gain has to be subtracted to prevent doubly counting that sale. Losing the loss of plant assets, Eureka's income statement shows there was a $3,000 loss on the sale of a plant asset. As was the case with depreciation, a loss on the sale of assets gets added to net income to reconcile net income to net cash flows from operating activities. The cash received associated with the transaction that resulted in this loss is reflected in the investing activities section of the statement of cash flows. Now, we talked about changes in current assets and current liabilities. Decreases in current assets, other than cash, have a positive effect on cash flows. Increases in current assets have a negative effect on cash flows. So as we went through some examples, when Eureka's balance sheet shows an $8,000 decrease in accounts receivable, we decide that collections were $8,000 more than sales recorded for the year. That's why we add that back to net income. So cash flow analysis, a decrease in an accounts receivable gets added back. Inventory, if there's a $34,000 increase in inventory, if there's an increase in an asset, what do? We subtract it. Because the cost of goods sold in 2014 was $520,000, the total cash paid for inventory is we paid more cash for inventory. Therefore, we have to show a minus related to our net income because we used up cash that's showing as inventory, not part of the expense account. Let's see here. Operating we've done. Let's look at investing now. In this portion of the cash flow statement, accounts involving cash receipts and cash payments from investing activities are examined. The object is to explain the change in each account balance from one period to the next. So with Eureka's investing, they purchased investments in the amount of $78,000. Did they use cash to do that? They used cash to do it, therefore cash decreases. Then they sold $102,000 in investments that cost $90,000. When they sell investments, they gain more cash, don't they? Then they purchased plan assets in the amount of $120,000. How do they purchase them? Cash. Then they sold $5,000 of plan assets that cost $10,000, and that had accumulated depreciation of $2,000. So when you sell plan assets, you ultimately gain cash. I think the best way to do this is to go over problems like we were doing, okay? So let's go back, and let's go back to cash flows from investing activities and non-cash transactions, SE4. During 2014, Fargo Company purchased land for $375,000. It paid $125,000 in cash and signed a $250,000 mortgage for the rest. So what happened here? It increased a liability, didn't it? The company also sold for $95,000 cash a building that originally cost $90,000, on which it had $70,000 of accumulated depreciation, making a gain of $75,000. Prepare the cash flows from investing activities section and the schedule of non-cash investing and financing transactions on the statement of cash flows. So we're going to deal with the purchasing of land and the selling of a building. So we've got the sale of the building gave us $95,000 in cash, didn't it? The purchase of land, we used in cash $125,000 of our own cash. Okay? So from the standpoint of the investing piece, the sale of the building added cash, the purchase of land, we used cash. Now when we're dealing with non-cash items when we had a mortgage. We received a mortgage in partial payment for land. Does that mortgage give us cash? It increases our cash, doesn't it? An increase in accounts payable, we add it to our cash. A decrease in accounts payable, we subtract it. So under the indirect method, the gain of $75,000 would appear as a deduction in the cash flows from the operating section. So the key here is when we sell a building, we increase cash. When we purchase a building, we decrease cash. When we take out a loan or increase our loans, we add to cash. Let's look at SE5. Actually, let's look at E5A. Wilma Company's T account for long-term available for sale investments at the end of 2014 follows. We started the period with a balance in investments of $76,000. During the year, we purchased investments of $116,000, and we sold investments for $78,000. In addition, Wilma's income statement shows a loss on the sale of investments of $13,000. Compute the amounts to be shown as cash flows from investing activities and show how they appear in the statement of cash flows. So two things I want you to think about. In the investment section, when we purchase investments, what happens to our cash? It goes down. When we sell investments, what happens to our cash? It goes up, right? So, in this example, the purchasing of investments we show as a minus, using up cash. The sale of investments we add back. It's a plus. Now, the one piece we need to look at is when we sell an investment for a loss. That reduces our net income, doesn't it? But since we're taking care of this investment in the investing portion of the cash flow statement, since when we sell an investment, if it at all affects our income statement, we're going to need to add back that loss. Because remember, the loss on the sale of an investment isn't part of the operating activities. It's part of the investing activities. And since we're showing what we sold, what we purchased, and what we sold as investments, we're taking the cash totally on the investment section. The portion of the operating side that may show a loss on the investment we're going to need to clean that up because we're showing it in another section anyway. Does that make sense? We'll go through a problem like this. Okay. Let's look at E8A. Keeper Corporation's income statement for the year ended June 30th, 2014, and its comparative balance sheet for 2014 and 2013 follow. Keeper issued a $22,000 note payable for the purchase of furniture, sold at carrying value furniture that cost $27,000 with accumulated depreciation of $15,300, recorded depreciation on the furniture for the year of $19,300, repaid a note in the amount of $20,000, issued $25,000 of common stock at par value, and paid dividends of $4,300. So what we have to do is, based on all this information, we are going to create a cash flow statement. So guys, we're going to pick it apart and take one piece at a time. Okay? So let's go to E5A, or E8. Okay, Keeper Corporation. The first thing we do is the operating section. So you want to make sure you title the report correctly. Keeper Corporation Statement of Cash Flows for the year ended June 30th of 2014. We start by showing net income. Now the net income, how are we calculating that? We go up here. Our net income from Keeper Corporation was $17,900. That's the first thing we're going to do. Okay? Then the next thing we're going to do is we're going to compare our various accounts receivable, our inventory, our prepaid expenses, and our accounts payable, our income taxes payable, all of these items that affect the operating activities. So we're going to start with our net income of $17,900. Now, we know in here it told us that we had depreciation expense, which is probably part of these operating expenses of $45,000. It tells us that we recorded depreciation on the furniture for the year of $19,300. That $19,300 reduces our net income. So the first thing we'll do is take our non-cash items and add those back. Adjustments to reconcile net income to net cash. Our depreciation, we add back $19,300. Okay? The next thing we're going to do is we're going to look at the change in our assets. In this case, we're going to look at the change in our accounts receivable, in our inventory, in our prepaid expenses. in our accounts payable, and in our income taxes payable. And we're going to adjust those accounts, our cash flows, based on the increase or decrease in those accounts. Remember, when we increase an asset, we subtract. When we decrease an asset, we add it to net income. When we increase a liability, we add it to net income. When we decrease a liability, we subtract it. So, as you see here, our accounts receivable went from $26,000 in 2013 to $21,000 in 2014. The accounts receivable went down $5,000, right? So that alone, because there was a decrease in accounts receivable, we added. There was a decrease in inventory, we added. Prepaid expenses, look at this though. Our prepaid expenses went from $2,600 to $3,200. So our asset increased, we subtracted. We used cash that didn't get reported on the income statement. So in this case, we're going to take our increase in our prepaid expense, subtract it. We used up cash, but it wasn't reflected in the income statement. Then we go back here and look at our liabilities. Our liabilities went from $14,000 to $13,000. We used some cash up, didn't we? We're going to subtract that. Our income taxes payable went from $1,800 to $1,200. We used some cash there. So our decrease in accounts payable, we subtract. Our decrease in our income taxes payable, we subtract. We take our net income, and then we take our additions and subtractions here, come up with a net of $27,100. We're going to add our net income to the $27,100 to come up with net cash flows from operating activities of $45,000. Okay? Next, we're going to look at investing activities. Now, let's go back and look at those items for investing. It tells us Keeper issued a $22,000 note payable for the purchase of furniture. Sold at carrying value furniture that cost $27,000 with accumulated depreciation of $15,300. Repaid a note in the amount of $20,000, which is going to be under financing. Issued $25,000 of common stock, which is financing. Paid dividends of $4,300, which is financing. So, under the investing portion, we sold furniture. It's $11,700. We said we sold at the carrying value that cost $27,000 with accumulated depreciation of $15,300. Keeper issued a note payable for the purchase of furniture. Sold at carrying value furniture that cost $27,000 with accumulated depreciation of $15,300. So the carrying value would be the $27,000 minus the $15,300 gives us $11,700. You see that? What we paid for it minus what we've used up in depreciation on it is $11,700. So we have $11,007 we've received in cash as a result of the furniture sale. Next, we're going to go to our financing activities. It tells us Keeper issued a $22,000 note payable for the purchase of furniture, repaid a note in the amount of $20,000, issued $25,000 of common stock, and paid dividends of $4,300. So the payment of the note payable, we used up cash of $20,000. By issuing common stock, we received $25,000. By paying a dividend, we used up $4,300. So the 20 minus 20, the plus 25, and the minus $4,300 gives us a net cash flow from financing activities of $700. If we take the $45,000 plus the $11,700 plus the $7,000, we have an increase in cash of $57,400. From that, we go back and look at the cash at the beginning of the period, $12,500. So the cash at the end of the year is $69,900. So basically, can you see here? The cash at the beginning of the year was $12,500. Do you see the cash at the end of the year was $69,900? So we're basically reporting how this number went from $12,500 at the beginning to $69,900. We're basically tracing through how the cash functioned through net income. Okay. Now, as we move on, we're not going to worry about the ratios. Let's look at problem 1. Problem 1 wants us to take these various transactions and analyze them. Analyze each transaction listed in the table that follows and place an X in the appropriate columns to indicate the transaction's classification and its effect on cash flows using the indirect method. Okay? So paid a cash dividend. What section is that going to go into, guys? What? Financing. Paid a cash dividend is going to go into financing. When you pay a dividend, it will always decrease cash. Okay? The next one says decreased accounts receivable. When an asset is decreased, it's always going to affect your operating. Accounts receivable will affect your operating activities. When an asset is decreased, you add it, don't you? So it will always increase your cash flows. Look at your cheat sheet. When you increase inventory, that will affect your operating activities. And increasing inventory means you used up cash that's sitting in inventory on the books. So it's going to decrease our cash flows. Incurred a net loss. When we're showing there's a net loss, it's going to affect our operating activities, and it's going to decrease our cash flows. Declared and issued a stock dividend. Stock dividend, whoa! Does stock have anything to do with cash? Does it? You see how it says non-cash transaction and there's no effect? Do we pay money for cash, for stock dividends? No, we just issue more stock. Retired long-term debt with cash. When? But we declared we didn't issue shares of stock, we issued a stock dividend. So when we're issuing a stock dividend, we're not giving them cash, we're just giving them more shares of stock. So it ultimately dilutes the share price or the value per share. When we retire long-term debt with cash, this is part of financing. And what happens to our cash? Do we use it? Yes, it's going to decrease our cash, won't it? Right? Sold available for sale securities at a loss. So we invested in some investments. So it's going to affect our investing section. And when we sell securities, we get money, don't we? Right? Now, they're trying to trick you saying they sold them at a loss. Ultimately, we still got money in this period. Issued stock for equipment. Well, if we issue stock for equipment, we didn't have any cash that affected us. It's just diluting our stock again. We decreased prepaid insurance. Prepaid insurance is part of the operating activities. When we decrease an asset, we add it, don't we? We increase our cash. I want you to take 10, 11, 12, and 13 and try to think through it using your cheat sheet right now. Okay?